Hello, welcome to this short introduction to how we distribute cash flow in a return on capital arrangement in an equity joint venture. Our scenario that we're going to walk through is this short 2-year holding period. I encourage you to press pause now and work through it on your own before coming back to walk through it together. Our first step is always to develop the equity before tax cash flow line. We need to know what the equity investors' earnings are as a group. So we need to know the unleveraged cash flows, what we earn from the property, what we have to pay off our lenders, the debt cash flows, and what results is what is earned by our equity joint venture. If this isn't immediately obvious to you, please go back and rewatch the videos on debt cash flows and calculating equity before tax cash flow. What we're focused on here is the scenario called return on capital. It's an agreement where instead of paying back our investors' principal or equity investment over the course of the holding period, we are going to pay them interest payments, or analogous to interest payments, which is called the pref, or the preferred return. But any money left over is actually going to flow through the promote structure, not through a return of capital. So let's focus on this priority system. Notice that we have two sets of rules here. We have a set of rules associated with distributing income during the holding period. So we would call this an interim period, not the purchase period, not the sale period, where we receive regular income from our investment. Notice there's only two steps. One, we pay the pref, and if there's money left over, our second step is to have the money trickle through in our equity waterfall. So a big difference here is that we add our return of capital only in the final period, when we sell the asset. So on sale of the asset, and this can also include income from that final year, we would have the pref that we would pay over with the income, and if we're unable to make it up with the income from that final year, we would use some of the sale proceeds first to make sure that the preferred return is paid. In some agreements, we may have to make up preferred return that we were unable to pay to our limited partners over the course of the investment. That's called a look-back clause. We're not going to assume one exists here. Second, we need to return the initial equity investment back to each class of investor, and this is done on a pari passu basis. If there is money left over after we've returned all capital to each party, then we have another waterfall event where the sponsor earns a promote or a greater than pari passu return as an incentive to make that waterfall have as much cash in it as possible. So you notice at the bottom we have a table that gives the summary cash flows. Disclaimer, you only can get this once you have gone through each individual's account. And that's what we're going to do together. So we're going to open up Excel. Into our template, you will have a template on your course materials. And we're going to go period by period and use the rules here of a return on capital to pay cash to each party in the equity investment. We start in period 0. The first thing we have to do is raise $500,000 of equity for this investment. And it's agreed that our outside investors, or our LPs, limited partners, will contribute 90%. And our general partner, or the sponsor, will contribute the other 10%. Now at the end of period 0, there's no other cash flows that occur. This is the capital raising part. We simply have a balance of what that investment is. So let's now move to period 1. This asset earns $60,887. So we go through our distributions during the holding period protocol. The first thing we need to do is pay off the prefs. So in this case, at the beginning of period 1, each investor has their initial investment outstanding, and they are going to earn the preferred return, which here is 8% on that capital they have invested. So $36,000 for the outside investors, and just copying over the same formulas, $4,000, which is 8% of $5,000 for the sponsor or the general partner. Now, a big difference between this and return of capital is the next step is the waterfall. So we know that we have only spent $40,000 of that $60,000 on the preferred returns, and we've paid them all out. So what happens is any remaining money is distributed according to the waterfall structure. So that $20,887 is not distributed pari passu, it's distributed with the promote. So the outside investors would get a demote, or only 70% of this waterfall. The sponsor receives 30% of that waterfall. Now notice we did not return any capital. So the capital balance at the end here is the same as it was in the beginning. So think of this as very analogous to an interest-only loan. We are not paying off the principal over time. We are simply paying the preferred return, which is similar to an interest payment. And then the excess money left over is distributed based on an excess return or a waterfall promote structure. Period 2 now is our reversion. So the first thing we need to do is, again, we've had another year of income, another year of holding periods. We also have to distribute the pref because there was income earned in that period. So the first thing I need to do is calculate the prefs. Now, there's no difference between the pref in year 1 and year 2 because we never paid off any of that capital. So it remains 8% of $450,000 for the LPs and 8% of $50,000 for the GPs, the general partners. And again, we have $40,000 that was distributed in the preferred return. Make these positive so I can add numbers in the end. Again, I like to keep positive cash flows to the investors as positive numbers. Now what's left? We've paid $40,000 to preferred returns. We have $539,000 left. The next thing we have to do is return capital. Now we know that there's $500,000 outstanding, but I'll do this by investor. So we know that this has to be a $450,000 payment. That's what they have outstanding, right? We need to pay back the capital they had invested, and we have enough to do that. Likewise, we have to pay back the $50,000 that the the general partners have invested as well. So this is going to be, I'll add them up, $500,000. So what do we have left? We have the initial amount that we had to distribute. We had to pay $40,000 for the pref, $500,000 for the reversion. Now we have $39,660, and that goes into our final period waterfall. So distributed just like the waterfall was during the holding period. 70% to the outside investors, and 30% to the sponsor or the general partner. And now we've paid back all of the capital invested to both parties, and everyone's happy. So let's calculate the returns here. So we know that in period 1, the LPs, the limited partners or outside investors, invested $450,000. In year 2, they receive $36,000 and $14,000 in the waterfall. So they receive a total of $50,000, $621 of that $60,000 earnings. Our final period involves the preferred return plus the return of the capital plus our waterfall, and so they've earned $513,000. Same thing with our sponsors' return. They put $50,000 in the pot right away. They earned $10,266 between the pref and the waterfall. And in the final period, they earned $65,898, again, from the preferred return, the return of the capital, and the waterfall. So let's calculate their IRRs. 12.62% for outside investors, and much more, 25.53% for our sponsor. So if you compare this with the return of capital, notice that our sponsors have received a slightly higher return here. And that's largely because they were able to participate in the waterfall, which gives them their excess returns earlier than they would have in return on capital, where that waterfall tends to be big but only happen at the end. So that is return on capital. Thanks for watching.